Hello and welcome to Fireside with the VC. My name is Andrew Romans, and I'm very excited to have Yash Patel on the podcast. Yash is a general partner at Telstra Ventures. Yash, how you doing?
Doing great, Andrew. Thanks for having me.
Yeah, good to see you again. So I've spent a lot of time studying corporate venture capital, advising corporates on their corporate venture capital, and I think you guys have a very interesting story, from birth to where you are in evolution. I think that almost every CVC I know is not a static thing, but they're always developing and changing. So before getting into that and some other fun topics, maybe give us a quick background about, the parent company, Telstra. Like who
Yeah,
is Telstra?
no, absolutely. And the way I describe Telstra to a lot of folks in the U.S., if they're not familiar with us, is we're sort of the Verizon of the Australia region. And when I say Australia, we also include kind of Asia Pac as well as China and India, where Telstra has a bunch of infrastructure assets. And so Telstra is considered sort of the premium network, in the Australia region. There's obviously other competitors out there like Singtel, which operates a brand called Optus, as well as a few others. But Telstra generally, invests a lot in its, infrastructure, cell towers, 5G, et cetera, and kind of commands that sort of premium tier, both across consumers as well as multinational corporations that kind of use Telstra. So that's kind of Telstra at a super high level. It's a 25, $26 billion revenue company, strong free cash flow, like you can imagine, but always looking for growth, which is always, the name of the game in sort of the telco industry.
I actually grew up in a telecom family where my parents worked at AT&T, my mom and my stepdad, and then that led me into a telecom startup. So I've kind of been breathing the evolution of telecom from before deregulation to kind of where we are now. And when I think of telcos used to own the yellow pages, directory of service, and when cell phones came out, there was people calling 10 times a day before there was Google in your pocket, or to say what's the phone number for the pizzeria even. And like all that went to Google, and then owning the infrastructure assets and not taking advantage of, they were the only ones who knew your position. So if you get off an airplane and you're in Piccadilly Circus, they should be offering that guy a hotel room. So I think that as much as these telcos are powerhouses, 20 billion, 100 billion in revenue, I think they need venture capital more than almost anybody to, figure out how to diversify ARPU, lower ACPU, compete, even evolve into something different.
Absolutely. And Andrew, you bring up a really good point. Revenues don't mean much if you're sort of seeing, stagnant or declining revenues that are sort of decaying at a faster rate than the rest of, the industry. And so one of the things that, telcos across the world, including Telstra, is really focused on the application layer,
Right.
on top of the network. So both on the consumer side, which a lot of these telcos have big businesses, but also very importantly on the enterprise side. So whether it's unified communications or it's mobile gaming and esports, how can we kind of participate further up the chain and monetize through kind of interesting new business models? That's where we as venture capitalists get really excited in sort of investing in the future beyond kind of the infrastructure.
And you're based in San Francisco, Silicon Valley. Telstra originates from Australia, but operational across Asia Pac. What percentage of your capital is deployed in Oz compared to these other regions?
Yeah. Let me give you some context on our fund, just real quick to put it all in context. We're a $565 million fund, and the vast majority of it, 70 to 80%, kind of comes naturally from Silicon Valley in North America, just because you kind of see a lot of innovation and just the sheer, kind of deal flow volumes are larger. Having said that, we also have a presence in China. We have two folks in Shanghai, China, and then naturally have a few investment professionals and back office staff in Australia. So we do cover those regions as well as Asia Pac pretty expansively. But
Mm.
by far, the vast majority of innovation we see kind of comes from the U.S. and that's kind of reflected in our portfolio today, where we've made about 70 investments, but about 70-80% of that is U.S. North America based investments.
And I think before we get to the evolution of how you guys have taken outside and kind of spun out a bit, part of the objective of CVC, corporate venture capital, is strategic returns or synergies with the BUs, the business units, and the startup. So if it works well, the startup has not just a check that didn't bounce from you, and not just a promise from every VC has got a big network and going to help, but you actually figure out how to deal with your staff in Melbourne and actually navigate through to BUs. What's an example of you guys actually taking a startup and helping it even internationally or at all?
Yeah, no, it's a great point, and I think we take a lot of pride, and I'll explain in a second how we look like now versus maybe 7 years ago when I first joined. But we take a lot of pride in driving strategic synergy revenue across our portfolio where it makes sense with Telstra, and we'll call it our kind of network of other kind of partners in not only Australia but Asia Pac, Japan, and kind of other geographies. And we very much metric how much synergy revenue we drive across our portfolio. And usually that kind of comes in the form of Telstra either as a customer of a solution or more importantly as a reseller of a solution. A great example of that, and you can talk to the CEO of Box, Aaron Levy, was really our investment in Box, but more importantly, the value he saw in us helping them crack kind of Asia Pac through kind of Australia. And so, Telstra, is obviously sort of a big customer, and that's kind of the low hanging fruit. But we really helped in terms of reselling Box, amongst a bunch of other solutions in the Telstra kind of suite, on Telstra paper in that region. And I think that in a lot of ways has been a really good model that Box has been able to use across different geographies in terms of the partnership kind of model go to market. So we also did that with DocuSign, which was one of our kind of earlier investments, and we continue.
When did you guys invest in DocuSign? Was that during Keith Croc's watch?
Yes, yeah, exactly. And so Mike Dinsdale was the CFO at the time. He's since gone, but it was a strategic round. We invested it in, right. I think it was just around $1 billion or just before that. Just before that in terms of valuation. But you had ourselves, you had a few Japanese telcos, you had a few others on the strategic side that all kind of invested in this large kind of round, which was mainly focused on strategic expansion, for them. And so that was really great. DocuSign ended up, I think they ended up poaching some of the Telstra folks, so that didn't go totally as planned. But from our perspective, it went exceedingly well.
I mean, Keith Croc is one of these iconic entrepreneurs. If you're in his grace, there's a chance to even leave Telstra and work for him. He's an amazingly contagious, dynamic, founder. He told me when he first joined how he was going to focus the company on just real estate, and that for real estate, signing of the documentation electronically would be the mechanism to get across all industries. And why would anyone not use DocuSign? It's rude to ask me to print, scan,
Yeah.
without it. At the same time, I remember saying to him, is this really a company? Because it looks like a feature. Like, how can you really grow DocuSign into a monster company when give me 15 minutes in the Ukraine and I could have something working?
No, totally. As I remember, as part of our kind of investment diligence, I kind of looked at, along with our other partners, at least like 15 to 20 other small competitors. There's all these like PDF makers, a whole bunch of guys out there that were doing kind of signatures. So it definitely is a crowded, kind of saturated market. But I think the Trojan horse strategy of just cracking the real estate agents really kind of drove sort of an organic viral kind of element that spread to kind of other industries, right? So if you're sort of a real estate agent, kind of having your clients kind of DocuSign, those clients, might work in, financial services, might work in retail, might work in other kind of industries, and, really start to adopt something. One of the things I liked about DocuSign was sort of the consumerization of the product, which, in a lot of ways is kind of how you see, the Snapchats, the Facebooks, and the others of the world kind of grow is really kind of through this kind of viral coefficient, this word of mouth effect. And I think DocuSign did a good job on the go-to-market side that gave us a lot of confidence that they could kind of, expand not only in the US, but in Australia, Asia Pac, and kind of beyond. And it's been, very good return for us as you can kind of tell with their market cap since.
Oh yeah, no doubt about it. I mean, takeaway there to move on to the next topic here is sometimes you look at things and say, well, this biotech thing, it's about the molecule. It's not about the management team. And that's not true. It's not about the molecule. It's always about the management team. And, some people, the wrong guy could screw up something that's taken off like a rocket. But I think Keith just kept powering you and anybody else to follow him into this is not a commodity. Let me tell you why. And it's actually a brand. I mean, it's like you don't have to use Zoom, but it's a little bit like we pay for an office, we pay for Zoom, we pay up for DocuSign, but he's a really fun guy. So Yash, tell me the story of when you started at Telstra Ventures quite a few years ago now. You were probably a full-time employee of the corporation. You might have had some sort of bonus that was tied to a DocuSign performance, but often the attempt of synthetic carry, where you give the corporate venture capital, corporate employees bonuses tied to like a real 2 and 20 structure. It's happening and it should be happening, but it's not easy to have happen. Maybe tell us the story of going from there to where, and explain how the fund is really an independent fund now.
Yeah, no, it's an interesting evolution. So when I first joined in the beginning of 2014, we were very much a business unit within Telstra, and we were actually, and we've moved around a bit, but we, at various times were under the strategic finance kind of organization within Telstra, usually reporting, to the CFO of Telstra. But we did also have a board that used to make decisions, when we presented, investments like DocuSign, Snapchat, Skills, et cetera, that would basically, have to unanimously agree. And that board included the CFO, at times the CTO, and 2 or 3 other folks, head of enterprise sales at Telstra, that would kind of weigh in. And so, our kind of whole process was, we find an interesting company. We're hoping for, strategic synergy and business unit approval, which is, one of the first pieces of criteria. But then we're also evaluating the returns. And we are very disciplined about making sure we invest in companies that generate great returns. And so our fund was really an evergreen fund, within this business unit in Telstra. So, as soon as we got exits, we kind of reinvest that into the fund. But each year, Telstra would commit a certain amount into our fund. And, I think it ended up working pretty well. I think for us, we didn't get too strategic, but we didn't get too financially focused. We were sort of a hybrid model in that we used to, very much metric our strategic synergy, but also stay very disciplined on the returns. And then over the years, we realized, and I think Telstra realized that there was sort of this natural tension that was kind of happening between the business units who weren't necessarily focused on some of the horizon 3, 4, 5 type of opportunities, 3, 5, 10 years out, that we were focused on when we make our venture investments. And naturally so, right? They've got earnings per share, they've got other MBOs they need to focus on, and other metrics. And so I think at some point, the tension became not too much, but it became a talking point between ourselves and Telstra, where it sort of made sense for us to kind of become independent and do 2 things for Telstra. One, kind of help shift the burden of the capital that they were committing into our fund to someone else, but 2, allow them to still benefit from the insights that we're driving through our venture investments. And so, for them, the strategic synergy, we metric it, each year, and we've even got 2 or 3 folks, even more actually now, that are still focused on driving synergy across our portfolio. But that doesn't move the needle for a multi-billion-dollar organization. It's a great way to keep us honest and accountable, and we love it. But for them, they want to see great returns. They're very financially focused, but they also want to see that there's engagement across Telstra. So one of the things I think I mentioned to you before was we send, right now we're an independent fund, and I can kind of talk about how we brought in a few external LPs, but we send an email out every week
Oh
throughout
yeah.
all of Telstra, which is really interesting. And that's something we did 7 years ago, but it drives a lot of engagement and kind of a discussion with a lot of the business unit leaders within Telstra, even to today.
Yeah, if I were, I think I said this to you when you first told me about that. If I was aware of that when I was writing my book on corporate venture capital, I would have said, this is a great idea that might look like a little bit of a pain in the ass at first, but is so well worth doing. If you can, I mean, even as our venture firm at 7BC Venture Capital and Rubicon, we've got like 57,000 people on our mailing list. And if you want to say, hey, we just invested in Box and give it a push and a bump and get other VCs interested, that's good. But what you're doing there is you're sending out some email every week. It's going to how many people inside of the BUs?
It's going to the top execs, right? So the top 50 to 100 kind of execs at Telstra, who all see it, and they share it with their kind of direct reports. So we get
Right.
a lot of inbound from very interesting folks that may not even be business unit leaders, but maybe kind of product managers, engineers, et cetera.
Yeah. I mean, usually I'm focusing, the key thing there is communication. So if you've got good communication in a marriage, it's got a better chance than if you have poor communication, and the same in business. And when you have physically people like you in San Francisco, in Silicon Valley, and these guys all the way back in Australia, and you're running around with a lot of money, and they may not really be paying themselves the biggest amount of money either. If they don't hear from you, they're just like, why did you invest in an esports gaming company? I just don't get it. Whereas if you can say, I just got back from this esports thing and I'm excited and this is the next box, they're along for the ride. I think that communication makes them understand just on every level, renewed support, less resistance. There's a lot there.
No, totally. And you bring up esports and gaming. It's such an interesting case study for us. About 3, 4 years ago, we started really diving deep in sort of gaming and the esports ecosystem long before it kind of became more mainstream and then even more mainstream with COVID. At the time, I think we kind of bucketed, our investments in esports and gaming as maybe not necessarily immediately strategic, but eyes and ears in that, we were still part of Telstra. And so we kind of had this 15-20% allocation agreement with Telstra that these would be investments that weren't necessarily going to drive revenues or synergies right now, but could be interesting. Fast forward to today, I'm having multiple business unit conversations, very much interested in my portfolio around esports and gaming. They're looking to move into the application layer around kind of this area of interactive media in a much bigger way. And we've got some great case studies with Skills and Team Solo Mid, one of the largest esports franchises that we invested in the world, that we've been able to bring to them and kind of drive their thought leadership there as well.
Well, I think that ties together to your earlier point, Yash, which was that the nature of a publicly traded company, struggling to get a multiple on their top line sales for the market cap is driven by by quarterly numbers. And it's that myopic, unpublicly traded, my employment contract of my compensation, mine meeting the CEO and the CFO and these other guys, is literally every 3 months. And for you to be out there talking about horizon 2, 3 forward thinking strategy where we're not day traders, we're holding stock sometimes for 7 or more years. um, I think it's very useful to have you guys out there as eyes and ears of the emperor to be able to bring information in those weekly reports, more in-depth reporting, and then show over time. People are pitching us today on stuff that's going to exist in the future. We can see the future if you let us be really active.
Absolutely. And I think what's given us a lot of credibility there is, we've been around for 10 plus years, every 3 years, a business unit that may have rejected a deal we brought back will kind of come back to us and say, hey, this was actually really interesting. And in a lot of ways, and we don't explicitly track this, but we kind of do in a certain way, we kind of track our anti-portfolio in terms of companies that we were interested in when we were under Telstra, but for various reasons and very reasonable, kind of reasons, the Telstra business unit leaders were not interested in. And we track that not so much because we want to rub it in their face. It's more, it's a way of showing, hey, we actually are proving this out, and looking at a lens that is 3 to 5 years out. So next time we kind of bring something to you guys, even though we're an independent venture fund right now, they actually get really excited. They want to lean in, and they want to get more skin in the game.
And that's an exact example of evolution rather than we've got the model right, it'll never change. That's just being a child. These things are always changing. So the anti-portfolio, I remember when I was an entrepreneur raising a couple hundred million of venture capital funding myself as the entrepreneur, I remember Bessemer had the anti-portfolio on their website. And I think Cisco, or no. They would list what they passed on with a quote from some idiot general partner who blew it. And they had something like,
Yeah.
this guy, John Chambers, is pitching me to invest in Cisco. Why would anyone ever need a gigabit router back when we had like 96 baud modems that shows how much they missed it. And they were laughing at it. I guess if you're Bessemer, you can laugh at it. For me, the anti-portfolio is getting less funny by the day. Like when I think of some of the deals I've missed out on, it's quite upsetting. But for you to be able to rub their faces in things like Cisco they may have missed out on and quote them back, maybe helps drive the evolution of how your IC investment committee works. So I want to talk about investment committee, but before we do, just to be clear, you went from being on the balance sheet evergreen fund employee or corporate employees to now bringing in outside matching capital. Can you disclose what you told me about? I think you can, right?
Yeah, no, absolutely. So we now have 4 kind of limited partners, and we basically our 2 biggest LPs, our anchor limited partners, are Telstra, which is still very supportive, and HarbourVest Partners out of Boston, and they've got an office out of Hong Kong, and we're working with those folks. So they're one of the larger fund of funds, and many of you kind of listening to this are probably familiar with them or might have investment from them. So they have been very supportive, and then we've got 2 other kind of Australian kind of financial funds also involved, and we're investing out of this second fund, $565 million fund, but also looking to close our 3rd fund very shortly. So I'm pretty excited about kind of the future.
So that's gone to a full-blown 2 and 20 fund with HarbourVest, massive institutional LP matching the corporate anchor, and at least for now going with the Telstra Ventures as the brand, with that continuity. On the IC, like in the old days, and I've been on some of these ICs where if the CTO or the head of R&D has got a voting seat on the investment committee and you're investing early stage, they look at that and go, oh, we're already working on it. Like they're insecure about NIH not invented here, or, oh, I easily could make that technology there's no reason to pay up for that crazy valuation. Or they're insecure that they don't have video on demand or whatever the hell it is already up and running. So I find it can be a little unhealthy to have them on board sometimes. On the other hand, after you're trying to push it into a BU to partner and have a commercial agreement, and the guy's resisting because he doesn't want to tarnish his career with being a guinea pig, you can say, hey man, get in line, because the CEO, the CFO, the CTO all signed their names on it. Don't let me out you for not going with the flow or something. What's your experience on IC at that level, and where has it evolved to today?
Yeah, so we started off as a 5 or 6 person kind of committee that required unanimous approval, and at various points in our time, I think we did have the CTO or somebody from the product side that was usually sitting there, and like many other corporates, you did have that natural kind of tension where the issue would be, Ericsson already covers this, and says Telstra has a very close relationship with Ericsson, or Microsoft already does this. Telstra has a close relationship with Microsoft, or we can build this internally, and that is a very legitimate kind of concern. And so one of the things that we did right before we spun out is, even though we were kind of still required to have the Telstra BUs, the Telstra Investment Committee kind of be unanimous in their approval, we internally as partners, we've got 6 partners, including myself, we used to all vote on it and kind of include that in our memos, so that we could show continuity post kind of our spin out, in that we actually had a different kind of method of approving an investment. We don't need unanimous approval. We just need sort of effectively a majority approval. And
Out of the six.
out of the six, exactly.
Okay, so for the Telstra Ventures team, you're a general partner. If you guys get more than half voted, you can push it through.
Yeah,
If you want to be that forceful.
Yeah, that's generally how we set it up. And we have a very strong belief that the best investments tend to be the most controversial ones. And so
Yeah, that's right.
we do not, in fact, sometimes we get a little bit, freaked out if we see everyone unanimously rejecting or approving something. In that, is there some perspective we're missing? And so diversity of thought is super important to us in terms of driving returns.
I mean, a quick story on that is that I love that statement. Sometimes the most contentious IC investment committee decisions were the ones that were the biggest outliers. Because if you're saying let's offer voice over IP to the enterprise, that's like not a new idea, but you could see it'll work. We all get behind it. The unit economics are there. Is it really going to be a blowout thing? I once, and everyone will think I'm super stupid hearing me say this, but at the time, I think my stupidity was acceptable. I was meeting with Global IP Sound, GIPS, who did the voice codec for Skype before Skype introduced any plans of monetization. And I was looking at it saying, how do you make money here? And they go, well, if Skype ever starts to charge for the free service, we get a rev share. And I was like, well, when are they going to do that? He goes, no plans have been announced. And it eventually became Skype out, get a phone number. It was murdering the calling card business and murdering the long distance plans on phones and everything. But I was just like, well, I don't see the revenue stream. All I see is the burn. And then GIPS got acquired for a huge chunk of Skype, and it would have just been life-changing for me. But so it's just to say that when it's really obvious, it's maybe not that disruptive or interesting. When it's really not obvious, you're either going to have a tough time getting it through, or someone's going to really be kicking the other guy later for voting it down.
Yeah, we have an interesting story about Zoom, basically, where we were looking at one of the C or D or rounds for Zoom, maybe even E, but we kind of brought it to our unified communications guys, and at this time we were part of Telstra, and Telstra has a very close relationship with Cisco, and Cisco WebEx was good enough as a product, but I don't think they or even ourselves could have imagined the kind of consumerization of the product, the viral kind of growth that we kind of talked about with DocuSign earlier, that would happen with Zoom to kind of basically just bring, video conferencing that doesn't suck, as Eric likes to say. And so, we have a great deal of respect for Eric, but I would kind of consider that as part of our kind of anti-portfolio. But it was one where, I think it was a bit controversial, and it kind of went the other way for us. Unfortunately, but there's plenty of examples of that.
Well, I think that's part of the skill set to be very successful in corporate venture capital, is to do all the work of financial independent VC does, and then do all this other work of being able to sell into the BUs and the corporate and the IC to get them to say, that your story about Zoom is don't get fired. You never get fired for going with Big Blue. That if you buy an IBM mainframe, even though DEC was half the price and 10 times better, digital, people were still buying the crappy IBM mainframe with a maintenance agreement that was costing more than the DEC machine, because they just don't want to get fired for going with Microsoft or going with Cisco, like you described. So as it stands today, you guys are off balance sheet, HarbourVest, two other financials in there, anchored strongly by Telstra. But what about the AC? So even now, when you're completing an investment, despite the diversified LP base, you guys have to have a majority within the 8 of Telstra Ventures, but do you still need sign off from inside Telstra?
No, so we never need any sign off from Telstra or any of our LPs. We operate very much like a Sequoia or Bessemer or Sapphire. kind of operate. And that is very beneficial to both of us. Now, obviously, if there's an area where Telstra has deep expertise around kind of the networking layer, or something that we actually would rely on Telstra's engineers for diligence, as an example, which would give us more confidence in the investment. Well, we'll absolutely rope them in. But from our perspective, we're independent, and even if Telstra may not like the investment, but we like the returns, and we think this is where the world is going, we would still make that investment. But I think Telstra has a healthy level of respect based on our track record, where it's very, very good, and the same goes for HarbourVest and our two other kind of financial LPs.
Yeah, I think that when you start hitting blockbuster hits, balls out of the park, the IC gets a little bit looser with you. I mean, and there's a lot of examples of that, where that's the reason the whole CVC worked, is because their first investment was $1 billion exit very quickly, very quickly or something. But I think CVCs, that, like, it used to be that you had 20% eyes and ears of the emperor, and so 80% had to fit somehow into the Lego blocks. I think that if a corporate is allocating capital year on year into a fund that takes a few years to maybe really get that lucky return, they should just say, look, as long as I get one strategic thing a year, or one strategic thing every 2 years, as long as you're paying us back 5x cash on cash multiple, and you're performing well, why should they demand that every single investment that gets funded by the CVC has to directly lead to a commercial agreement or something? But
Yeah.
my experience, they're not thinking like I'm describing. They're saying, what are you doing investing in that? More self-driving cars. We're Ford. We
Yeah.
just want to see direct automotive connection.
No, totally. And if you were Ford, I would say, hey, you should be looking at interactive media, right? So when this stuff gets totally automated, you've got one of the biggest screens and potentially CPUs that you can kind of, work around with. And there's a whole bunch of kind of other areas that you could kind of look at investing in. And actually, the auto guys that I've talked to are actually looking at that in a much bigger way.
Sure.
But to your point, for us, like, the synergy is important, but that weekly email is probably the most important thing. Because
I
that
think
conversation, yeah,
I think
yeah,
that's super smart.
totally. And so, you're right. A lot of CVCs don't, or at least the corporates don't necessarily, kind of think like that. But it's really just a matter of, proving that you can kind of generate great returns and getting one or two really interesting strategic deals done per year, and then building that credibility and that relationship so you can kind of win that trust over time. And
Yeah.
that's exactly sort of what we did. We would never kind of do this 7-8 years ago. I think we had DocuSign, we had Box, we had a whole bunch of others, CrowdStrike on the cybersecurity side, and then BigCommerce on the e-commerce side. Skills just about to go public through their SPAC. So there's just like a real kind of track record there that, both from a returns and synergy perspective, we definitely kind of pay attention to.
Yeah, and I think independence is good, and that successful financial return should calm down the CFO, and even calm I think the CEO often says, "What's more important to you? Financial returns or synergy, strategic returns?" And the CFO is saying, "You lose money, I'll cut you off." And the CEO is like, "Don't worry about losing money. We're a 100 billion-pound gorilla. I just want to get into the next new big thing." But I think that it's important, as you go for independence, to never lose sight of the fact that you have access to those BUs. Like you said, you can run something up the flagpole and leverage their domain expertise, which is beyond what your management fee could even afford to pay for. Like, these people, you got smart people on the payroll that you don't have to pay, that sort of have to answer your email, a little bit. I think that's genius. And if you could get some payment app on, Telstra's the largest telecom operator in Australia. That's the mobile internet and the fixed internet. If you could push something out, then you're doing more than a lot of other VCs are doing to help the company.
Totally. And that kind of promise really moves the needle for a lot of our portfolio companies, even, with Telstra as a customer, right? So, I mean, Telstra as a customer just validates, gives credibility. They can now go to, AT&T, Coke, Pepsi, whoever these other large conglomerates are, and say, hey, we've gone through the ringer with Telstra, and Telstra's engineers and product folks in Silicon Valley and beyond generally get a lot of credit for being forward thinking in terms of adopting new technologies. So we benefit from that as a independent venture fund, but we still have that relationship, and we do cherish that. So that's really important, even if it doesn't end up being real strategic synergy revenues. So we're focused on synergy revenue right now, but we're not totally focused to the point where, if we miss it by a few million, each year, we're going to say that was a failure. No, that's absolutely not the case. The conversations and the innovation that gets fed into the roadmap for Telstra at the corporate level, that is a result of our investments, is where I take the most pride in.
Well, Yash, I want to close on some questions about stage and sector, so anyone listening to this knows when to attempt to get your attention of their next financing round. So you guys are investing fairly late stage, right? What stage, what's your sweet spot for investing? What's a typical check size? What's a typical round size that you're participating in?
Yeah, no, great question. So we started off doing a lot of late stage stuff, but we really find our sweet spot at the Series B stage. So, we like to lead or co-lead investments at the Series B, usually writing $5 to $10 million US dollar checks. We'll also participate in these larger growth rounds, with at least $5 million. I think we just want to have enough skin in the game and be able to add value in ways that move beyond kind of the capital that we kind of talked about earlier.
So you're not overly concerned with ownership percentage targets, but more of I want to get in.
Yeah, exactly. So, I think we've started to move to the Series B just because we found it a bit frothy at the later stages, and you've got SPACs, you've got all sorts of investors, and we found that getting in at 100 to 200 pre, I'm just throwing out that number, but as a Series B kind of average, generally tends to be a good path to a 5x plus type of return if there's real revenues, et cetera. So if I were to quantify it, this is by no means a hard rule, but like let's say 5 million ARR, kind of seeing 3x year-on-year growth on the enterprise side, or 10 million daily active users about to monetize on the consumer side. That's kind of our sweet spot, and we can really pour gas on the fire, not only with capital, but really trying to get you guys plugged in, these entrepreneurs plugged into Asia Pac and Australia.
Yeah, I think when I hear entrepreneurs complain about, I don't want to even be introduced to a corporate because their investment committee is dysfunctional and I won't get money out of them fast enough, I say, take the meeting anyway if they're willing to meet you, because worst thing that happens is they help you navigate this labyrinth that's halfway around the world and get you an actual potential sale. And he might even be pushing for a sale as a favor so he can get the investment done. Like, don't say no to that. If you're rushing to invest in their company and they don't want your money, they can say no, right? Which they probably wouldn't do by the time you're ready to invest.
No, absolutely. I mean, what's the worst that can happen? You get a biz dev deal out of it, but not a venture deal. I mean, that's only going to help your financing, as well. So, absolutely agree. And I would say that I think certain corporate venture groups have gotten really good at improving how fast their turnaround is in terms of,
Right.
Initial meeting to term sheet stage to actually wiring the money. Obviously, we don't have that issue being independent and being able to kind of write our term sheets, but a lot of good venture groups on the corporate side are kind of getting up to speed and tuning that whole process in terms of feedback. So don't be afraid.
I often say that corporate venture capital is like an airplane cockpit, and there's a million little settings. And if you go into the cockpit, you could probably work with the team to get the settings a little more optimal. And not a, you're definitely not a dictator, right? If you don't, no one's going to walk up to Jeff Bezos and say, listen, Bezos, this is how I'm going to change everything, and you're going to get in line. He's probably going to, he's probably got some control there, right?
Yeah.
I think that that's how it is with corporates, that you can't always get what you want, but sometimes you get what you need. And if you're a little patient, you could do what you guys have done. You can move from being on the balance sheet and all that IC to having all the benefits without kind of the downside. I think it's great.
Yeah. And the only thing I'd emphasize is, our route, there wasn't a lot of precedent for us to kind of look up to. I think Sapphire or SAP Ventures had done it really well. And, a few of us have some really good relationships with folks there. But It's just all about, going to the Telstra corporate or your own corporate, each year and just presenting new data, new kind of credibility and new traction. And over time, it will make more and more sense, as you kind of, build that kind of credibility. So it's an ongoing thing. It never happened overnight for us. It was 3, 4, 5 years of just kind of talking to them, bringing up the idea, planting the seeds, and then eventually the stars kind of align. And it might be a CEO change, it might be something else, but there will be a change event that you will be in a good position to kind of take advantage of.
Yash, I tell the story of Sapphire, going from SAP to Sapphire in my book. And it's really because I was good friends with Jörg Sievert, who came into my office and said, we just went from on balance sheet to $324 million or some specific number like that with a full 2 and 20. And I said, well, good for you. What's next? And he goes, well, now we have to diversify the LP base. Because if we don't diversify the LP base, we could be out of business the minute there's a change of CEO or an economic downturn. So that, and then what's next? He goes, then we want to drop the name because we don't want people to think that they can't sell to Oracle if they take funding from SAP. So do you know what the first 3 letters of Sapphire Ventures is?
Yeah, SAP, I guess so.
And I think they're still in the Hillview building, they're in the same, they operate out of their offices in both London and the Valley. I've been in them both, but I think it's smart. I think it's cute that Sapphire has that legacy connection to SAP because SAP is like the best tech company in all of Europe. So
Totally. And they've actually pushed that whole envelope. And I have a lot of respect for those guys. I mean, they launched a Sapphire Sport, which was a $100 million venture fund backed by a whole bunch of US and international sports teams and owners. And they're really kind of pushing the envelope across a lot of different areas that they're choosing to invest in. And so that kind of linkage through the name back to their legacy, I could see ourselves doing something similar in the future, right? So I don't think we'll be Telstra Ventures forever, and we'll kind of think of something equally as interesting when we do.
Inside of Australia, it could be a liability, but like for example, Verizon Wireless Ventures is really a stupid name in the United States because the minute you like I took 27 million from Rich McGinn at Lucent as an investment into my company. And I had a great relationship with Chambers at Cisco until he heard that news. And then he said, you're the enemy. So all of a sudden the door was shut to doing anything with Cisco. And we had married with an irreversible action to Lucent, which practically went bankrupt during the time. Like their stock price went from 62 to like $3 or $4 during those days. If you take money, if you take money from Verizon Wireless Ventures, you may shut the door to Sprint, T-Mobile, and AT&T within the United States. If you take money from Telstra Ventures, all those telcos will say, oh yeah, I know people at Telstra. They got really smart engineers, like you said. That is an endorsement. It's in no way a liability. So I think there's times that it'll serve you really well. And in your case, not too many times it doesn't serve. Most people are kind of pissed off at the phone man for, not showing up on time. So there's a little bit of that legacy post office vibe sometimes, but I'm sure you guys will get it right. Well, listen, Yash, thank you so much. I look forward to talking to you offline about some deals, and I really appreciate you making time.